Question asterisk asterisk. Do you think Tesla's stock has dropped enough to become attractive to investors again? Or is there no bottom for this stock? Could it fall all the way back to 29? Answer: over the next couple of years, I wouldn't be surprised if it did. However, do you agree that Tesla and its stock are poised for greatness in the long run? In recent months, Tesla lost some investors but gained some bulls. The past year has been particularly rough for Tesla investors, leading many to sell their shares. Today, many believe Tesla and its stock are poised for success. Just a few days ago, Moody's Investor Service became the second credit rating firm to upgrade Tesla to investment-grade status, raising the company's credit score by one notch to Ba3. This follows a similar upgrade by S&P Global Ratings in October. Previously, Tesla's credit rating was Ba1, or junk status, according to Moody's Investor Services at the end of January. But yesterday evening, Moody's upgraded the EV maker to Ba3. Let's discuss this in detail. To the delight of Tesla stockholders and enthusiasts, Tesla now has a Ba3 rating from Moody's Investor Services with a stable outlook. Moody's has withdrawn Tesla's former Ba1 corporate family rating, the Ba1 PD probability of default rating, and its SGL1 speculative grade liquidity rating. This rating action reflects Moody's expectation for Tesla's future. Tesla will remain one of the foremost manufacturers of battery electric vehicles, with an expanding global presence and very high profitability. The upgrade also considers governance factors, including Tesla's prudent financial policy and management's operational track record, noted Moody's. So what does Tesla's Ba3 rating mean? With this rating, Tesla enters the investment-grade rankings. For context, Moody's rankings are divided into long-term and short-term categories. A Ba3 rating is in the long-term category for investment-grade issuers. In the short term, a Ba3 rating corresponds to a prime 3 P3 rating. Short-term ratings determine a company's ability to repay short-term obligations. A P3 rating indicates that Moody's believes Tesla has an acceptable ability to repay short-term obligations. Long-term ratings, on the other hand, refer to the relative credit risk associated with a company's fixed income obligations that have an original maturity of 1 year or more. Therefore, Tesla's Ba3 rating means Moody's considers the company to be subject to moderate credit risks. Companies with Ba ratings are regarded as medium-grade and may possess speculative characteristics. Numerical modifiers 1 through 3 are added to long-term ratings. Tesla's modifier 3 is at the lower end of the generic rating category, while the modifier 1 is at the higher end. Tesla will maintain its position as one of the leading manufacturers of battery electric vehicles as the company further solidifies its global footprint. Renee Lipsch, senior credit officer at Moody's, wrote in a statement. The credit grader also cited the automaker's expanding product offerings, including early production of the Cybertruck slated for later this year, its regional production facilities, and heightened focus on efficiency. Financial leverage is well below 1 time after Tesla repaid about $10 billion of debt in the last 3 years. Moody's uplift has both symbolic and practical value. Companies that rise from junk to investment grade typically benefit from cheaper financing by attracting a deeper pool of investors. In addition, a high-grade credential from at least 2 agencies is enough to be formally considered a blue-chip credit among rating-sensitive investors. Right, so Tesla is basically entering the blue-chip world now following this Moody's upgrade to, like you said, Ba3. This is important because when 2 ratings agencies give you that blue-chip status, it means cheaper debt issuance, more access to capital. This is a historic event for Tesla, said Joel Levington, a Bloomberg Intelligence credit analyst. We continue to believe the rating upgrade cycle for the company has. Tesla's move out of the junk-rated world after Moody's upgrade bodes well for the company, potentially narrowing views of credit risk against competitors like Volkswagen. However, Tesla cannot afford to be complacent as competition in the EV industry intensifies. Reuters reported that Toyota is working on a complete restart of its electric car strategy to better compete in the market, aiming to achieve carbon neutrality. Toyota's own technology, as well as the work we are doing with a range of partners and suppliers, is essential, the company told Reuters last year, declining to offer specifics at the time. According to 4 sources with knowledge of the developing plans, Toyota is considering a reboot of its electric car strategy to better compete in the booming market. The company has halted some work on existing EV projects as part of the strategy review. The proposals under review, if adopted, would represent a dramatic shift for Toyota and would rewrite the $38 billion EV rollout plan the Japanese automaker announced in 2021 to compete with Tesla. A working group within Toyota has been tasked with outlining plans by early this year for improvements to its existing EV platform or for a new architecture. Notably, Toyota has suspended work on some of the 30 EV projects previously announced, which, according to the sources and a document reviewed by Reuters, include the Toyota compact cruiser crossover and the battery electric Crown. In February, Toyota's next CEO, Koji Sato, with an eye on Tesla, Toyota is planning a next-generation EV platform push, driven by a grudging admiration for Tesla. This shift reinforces a stark realization at Toyota. Despite its expertise in electrification dating back to the first Prius hybrid, the company needs a significant leap forward for the new era of full electrics. Koji Sato, 53, who succeeded Akio Toyoda, 66, as CEO on April 1, said he is prioritizing a three-pronged strategy. This approach includes ramping up the automaker's EV strategy. Notably, in January, news emerged of Toyota investing $35 billion into EVs, but some say it may be too late. As one of the world's largest automakers, Toyota faces criticism for not moving quickly enough to reduce carbon emissions. Some critics even argue that it is opposing climate mitigation efforts. However, Toyota asserts that it does believe in an all-electric future, maintaining that this future will not reach all of its markets simultaneously. Toyota was once considered a pioneer in green vehicles when it introduced the Prius, the world's first mainstream hybrid vehicle, in 1997. The Prius combined a gasoline-burning engine with an electric motor and a small battery, allowing drivers to dramatically increase their fuel economy compared to traditional internal combustion engine-powered cars. Toyota's Prius proved to be a sales sensation. The automaker offered hybrid versions of much of the rest of its lineup, selling a total of 20 million hybrid cars, trucks, and SUVs worldwide, including 5.4 million in the US alone. Meanwhile, other automakers, spurred by stricter government regulations and the success of newcomers like Tesla, began investing in fully electric vehicles. For a long time, Toyota's leaders argued that there are fundamental engineering challenges to battery-powered electric vehicles. They take a long time to charge, require heavy and expensive batteries, and still have limited range. However, these criticisms are less valid now given recent improvements in battery technology, according to auto industry analysts. More importantly, companies have found a strong business case for EVs, with Tesla now the leading luxury brand in the United States. Toyota's new $35 billion investment, announced in December 2021, includes a plan to introduce 30 electric models by 2030, just under a quarter of the more than 130 models it currently makes. At the time, Toyota also said it would invest an equal amount in hybrids and hydrogen fuel cell vehicles. Gartner, an industry research firm, expects gasoline-burning engines to still make up about 50% of sales in the early 2030s. We still think that in 10 years, 50% of new vehicle sales will be gasoline, said Mike Ramsey, a vice president in Gartner's CIO research group. And if you look at the global footprint, that is almost certainly going to be true because you're not going to see in Nigeria, in Iran, in Indonesia, a 50% market share for electric vehicles, period. For now, this remains to be seen. Regardless of this conclusion, however, Tesla continues to dominate the US EV market, outpacing the next 15 brands combined. Notably, Tesla's shares grew by almost 52% year-over-year during Q3 2022, despite facing macroeconomic headwinds, according to Counterpoint Global's passenger vehicle model sales tracker. Battery electric vehicles, BEVs, constituted over 80% of total US EV sales, with BEV sales growing by more than 78% year-over-year during Q3.